One regulation, 27 member states, implemented 27 different ways. That is the core failure of PSD2 and why Brussels scrapped it. The European Commission has published PSR, the Payment Services Regulation, and PSD3. Together, they are the most comprehensive rewrite of EU payment services law since PSD2 came into force in 2018. But here's what most coverage gets wrong. This is not just a legal update. PSR and PSD3 exist because open banking created new fraud vectors, instant payments created new fraud speed, and PSD2's patchwork national implementations left the door wide open for regulatory arbitrage. If you're in fraud, AML, compliance, or payments operations at any EU-facing institution, understanding why the EU made this move and what the new structure actually does is not optional. It is the foundation for everything that follows in the next 2 to 3 years. Compliance and payments professionals, I want to hear your experience. Where did PSD2 create the most friction or fragmentation for your cross-border operations? Drop it in the comments. I read every response and it helps calibrate how deep we go on specific member state issues. Let us start with what PSD2 actually did well. It introduced open banking across the EU, allowing third-party providers to access customer accounts with consent. It mandated strong customer authentication, making card and account transactions meaningfully harder to access fraudulently. And it established baseline transparency rules for payment services. But open banking under PSD2 stalled. Banks built their APIs inconsistently. Some performed poorly on purpose. Third-party providers complained about obstacles, downtime, and deliberate throttling. The promise of seamless account access never fully materialized because PSD2 did not have sharp enough teeth to enforce it. The bigger problem was fraud. PSD2 was designed around unauthorized transactions, someone stealing your card details and using them. But the fraud landscape shifted dramatically toward authorized push payment scams, where the customer is tricked into sending money themselves. PSD2 had almost nothing to say about that. Then came instant payments. The EU push for SEPA instant credit transfers added another layer of complexity. When a payment settles in under 10 seconds, the time window to detect and stop a fraudulent transfer virtually disappears. PSD2's fraud framework was not built for that speed. And then there's the fragmentation problem. PSD2 was a directive. It told member states what outcome to aim for, not exactly how to get there. Germany implemented fraud liability differently to France. The Netherlands had different interpretations on SCA exemptions than Spain. A PSP operating across 8 EU countries was navigating 8 slightly different regulatory environments. So here is the structural answer Brussels chose. PSR, the Payment Services Regulation, is not a directive. It is a regulation. That single word changes everything. A regulation applies directly in every EU country at the same time in the same text. There is no national transposition, no member state discretion on core rules. One rulebook, 27 markets. PSR covers conduct. What that means in practice: transparency about fees and exchange rates, how payments must be executed and how fast, what consumers are entitled to when something goes wrong, liability rules for fraud and scams, verification of payee requirements, and platform duties. It applies to banks and non-bank PSPs alike. PSD3 is the companion directive. While PSR is the rulebook for behavior, PSD3 governs who gets to play. It repeals both PSD2 and the old Electronic Money Directive, EMD2, and merges them into a single authorization and prudential framework for non-bank payment institutions and e-money firms. Think of it this way. PSR is the conduct and fraud rulebook, how services must behave. PSD3 is the institutional framework, who can offer those services and under what conditions. They are designed as a package. Implementing one without the other misses the full picture. The Commission had 5 core policy goals for this package. First, combat and mitigate payment fraud, especially APP and impersonation scams. That is the driving force behind the new liability rules and VOP requirements. Second, strengthen consumer rights and redress, giving people clearer paths to compensation. Third, level the playing field between banks, which are heavily regulated, and non-bank fintechs and e-money firms, which sometimes operate under lighter touch rules. PSR and PSD3 close that gap. Fourth, fix open banking, making API access genuinely non-discriminatory and giving users proper dashboards to manage their data permissions. And fifth, harmonize enforcement so that a supervisor in Amsterdam and a supervisor in Vienna are applying the same standards with the same tools. These policy goals are not abstract. They connect to documented real-world trends. Impersonation fraud, where criminals spoof bank phone numbers, fake law enforcement identities, and create fraudulent investment platforms, grew year on year across the EU from 2019 through 2024. It accelerated after the pandemic, and PSD2 had no answer for it. Then there is the fintech growth story. E-money institutions proliferated across the EU, some with strong controls, some with gaps. Digital wallets, prepaid cards, and BNPL providers grew into systemically significant players while still operating under the lighter EMD2 framework that was not designed for that scale. PSD3 is the correction. Here is the timeline. The European Commission published its proposals for PSR and PSD3 in June 2023. This kicked off the standard EU legislative process. Proposals go to both the European Parliament and the Council of the EU, where member state governments negotiate. The European Parliament and Council reached a political agreement on both PSR and PSD3 in November 2025. That is the critical milestone. Political agreement means the core content is locked. The text goes through formal legal linguistic revision, then official adoption and publication in the EU official journal. Once formally published, PSR will apply directly across the EU after a short transitional period. PSD3 is a directive, so member states will need to transpose it into national law that typically takes 18 to 24 months. The direction of travel is clear. Do not wait for final commas to begin your program. Let me now walk through what PSR and PSD3 mean for each type of institution, because the impact is not identical across the board. Who you are determines where the biggest changes land. For banks, the biggest changes under PSR are in fraud liability, verification of pay requirements, customer journey design, and open banking obligations. Banks are already heavily regulated. Their capital and authorization frameworks do not fundamentally change, but their fraud controls, monitoring architecture, and complaint handling processes need to be rebuilt around PSR's liability logic. The challenge for large EU banks is harmonization. If you have operations in multiple EU countries, your current fraud policies and customer journeys may differ by market, because PSD2 let them differ. PSR eliminates that flexibility. You will need a single operating standard across all EU markets. For non-bank PSPs and e-money institutions, PSD3 brings the biggest structural changes: higher capital requirements, more rigorous safeguarding of customer funds, a requirement to have wind-down plans in place, and critically, your AML and fraud frameworks will be formally assessed as part of your authorization and ongoing supervision. The specific structural change for e-money institutions is that they become a subcategory within the payment institution framework under PSD3. That means if you are currently an EMI, your license conditions, your capital regime, and your governance expectations will be reset to align with payment institution standards. This is not a minor administrative update. Platforms face new obligations that most of them are only beginning to understand. Very large online platforms and search engines must verify that financial service advertisers are authorized or exempt before accepting their ads. And they can face liability toward PSPs if they do not act promptly on notified fraudulent content. This is a genuinely new area of legal exposure for big tech. For consumers, PSR brings better protections, especially against impersonation scams and misdirected payments. But it also brings more friction at certain moments: VOP warnings, cooling off prompts, stronger verification steps on high-risk payments. The right design makes that friction feel like safety, not bureaucracy. Let me quickly summarize the key differences. Under PSD2, no specific app fraud liability rule, open banking with implementation gaps, separate EMI framework, no VOP requirement, fragmented enforcement. Under PSR and PSD3, specific impersonation and app liability rules, fixed open banking obligations, unified PI framework, mandatory VOP, harmonized enforcement across all EU markets. Now I want to hear from the practitioners. Which specific part of the PSR or PSD3 package are you most focused on right now? Fraud liability, VOP, authorization changes, or the data and open banking piece? Comment below and tell me where your program is concentrating its effort. And here's the wider context. PSR and PSD3 do not stand alone. They are part of an interconnected EU control stack. AMLR brings unified anti-money laundering rules. MiCA governs crypto asset services. DORA sets operational resilience standards for financial entities. NIS2 extends cybersecurity requirements. A PSR implementation program that does not account for AMLR data requirements or DORA resilience standards will create gaps and duplication. There is also the longer horizon to consider. The EU is actively developing the digital euro, a central bank digital currency. PSR and PSD3 are designed with sufficient flexibility to accommodate a digital euro framework. How digital euro interacts with PSPs, AML obligations, and consumer data rights is a theme that will run through EU payments regulation well beyond the current implementation window. For a deeper guide on the PSR and PSD3 regulatory texts, including annotated versions of the key fraud and authorization articles, I have everything laid out at davincidiligence.com. The link is below. And if you prefer audio, the entire EU Payments Reform series is available on our Spotify podcast. Search Da Vinci Diligence. This episode has given you the architecture. Now the series goes into depth on each piece. Episode 2 tackles the liability rules head-on, exactly who pays what when a scam happens, and what appropriate fraud prevention mechanisms actually means in operational terms. Episode 3 goes deep into verification of payee, the design decisions, the matching logic, and how VOP fits into your fraud and AML analytics. If the regulatory architecture of PSR and PSD3 is relevant to your work, subscribe. Each episode in this series goes significantly deeper into the operational mechanics that matter for fraud, AML, and compliance teams. Episode 2 is already live. Who pays for fraud under PSR? Share this with a colleague who is still treating PSR as a legal-only project. See you there.